Good afternoon. Welcome to the June 2018 Quarterly Superannuation Update. My name is Mailene Wheeler and I am one of the Superannuation Advisory Managers. Okay, so we'll just start with our important disclaimer, just to let you know that any of the information contained in this presentation is intended for general use only and is guidance only. So none of the information presented should be considered as formal advice, and any imputation in that regard is specifically rejected. Okay, so these are my contact details. If you have any questions in relation to anything that's been raised in this webinar, please feel free to give me an email or give me a call. Okay, so as part of the June 2018 Quarterly Superannuation Update, we're going to be looking at a few things. So we're going to be looking at the upcoming important superannuation tax dates. We'll do an update of the status of superannuation legislation since the last webinar. We'll have a look at some of the key ATO website updates that impact super. We'll look at the new contribution caps for the 2018-19 year, along with other key super rates and thresholds that will apply for the 2018-19 financial year. We're going to briefly discuss the 3-year audit cycle discussion paper that the Treasury released last week. We'll also talk about the First Home Super Savers Scheme and access from 1 July 2018. Before finally, we're going to cover off on transition to retirement income streams. We're going to look at the tax implications and other considerations for TRISs in retirement versus non-retirement phase that have come about after all the changes from 1 July 2017. Okay, so upcoming dates. Let's have a look. So 28th of July 2018 is the key date for making your superannuation contributions, the super guarantee, for the June quarter by employers to funds. Some other key dates there, but mainly if we go to the next slide, we're going to see that 31 October 2018 is when anyone who has outstanding prior year returns is going to be required to lodge and pay their 2018 self-managed super fund annual return. So if all of your outstanding prior year income tax returns are lodged by 31 October 2018, the lodgement program due dates that apply to tax practitioners will then apply to your 2018 tax return rather than a date of 31 October. On this date too, if you've got a newly registered superannuation fund and you are not using a tax agent, you will be required to lodge and pay your tax return. And if you have a lost members report for the period 1 January 18 to 30 June 2018, you'll need to lodge this report, as well as lodging a departing Australia superannuation payments annual report. So those two key tax lodgement deadlines don't include your deadlines for activity statements or PAYG instalments. All right, so now let's have a little look at legislation updates. So the following superannuation related bills received royal assent. So the Superannuation Auditor Registration Imposition Amendment, ASIC Fees Bill 2018, passed both houses on the 28th of June 2018. So this bill was part of 4 bills to enable the recovery of ASIC's costs for specific regulatory activities. So it amends the Superannuation Auditor Registration Imposition Act 2012 to increase the cap on fees in relation to an application for registration to become a self-managed super fund. So the Superannuation Industry Supervision Amendment ASIC Fees Bill 2018 also passed as part of this package. So it amends the Superannuation Industry Supervision Act. It amends that legislation, to impose fees in relation to an application to vary or revoke the conditions to cancel the registration of an approved self-managed superannuation fund auditor. Okay. So the following bills are relating royal assent. So the Social Services Legislation Amendment, Payment for Carers Bill 2018, it amends the Social Security Act to introduce a fixed and a non-indexed family income test, $250,000 per annum for carer allowance and carer allowance child healthcare card for only claimants, and it applies to singles and couples from the 20th of September 2018. The following bills are before Parliament. So we have the Treasury Laws Amendment, Protecting Your Superannuation Package, Bill 2018. So this was introduced and read for a first time on the 28th of June and was referred to a Senate Economics Legislation Committee on the 21st of June 18. So this bill is aiming to limit the fees on low value accounts, ban exit fees, and prevent opt-out insurance for new members under age 25 and anyone with smaller account balances. It's looking at strengthening the ATO's role in reuniting small inactive balances by requiring the transfer of all superannuation savings with a balance below $6,000 to the Commissioner of Taxation if an account related to a MySuper or Choice product has been inactive for a continuous period of 13 months. It also enables the Commissioner to consolidate amounts that have been paid as unclaimed money, inactive low balance accounts and lost member accounts into an active superannuation account where the reunited balance would be greater than $6,000. The Treasury Law Amendments Enhancing ASIC's Capabilities Bill 2018 was introduced and read on for a first time on the 27th of June 18, and it contains amendments relating to the competition in the financial system. Okay. Another bill that was introduced to Senate and read for a first time on the 25th of June is the Treasury Laws Amendment 2018 Measures Number 4, Bill 2018. So the proposed amendments on this one include the following. Taxation legislation to enable the Commissioner of Taxation to issue directions to employers to pay unpaid super guarantee and undertake superannuation guarantee education courses and to disclose more information about superannuation guarantee non-compliance to affected employees. It's looking to extend the single touch payroll reporting to all employers. It's going to require more regular reporting by superannuation funds. It's looking to strengthen the Commissioner's ability to collect superannuation guarantee charge and pay-as-you-go withholding liabilities. It's going to enable the pre-filling of an individual's tax file number declaration and superannuation standard choice form by the Commissioner to the individual's employer, and also look at enabling and sharing verification of tax file numbers between the Commissioner and other government agencies. So there are also some more superannuation guarantee integrity measures, some superannuation fund reporting, and the extension of the single touch payroll. The Treasury Law Amendment 2018 Superannuation Measures Number 1 bill was also introduced to Senate and read for a first time on the 25th of June. It's looking at amending the Income Tax Act to provide a one-off 12-month amnesty to encourage employers to self-correct historical superannuation guarantee non-compliance. It's looking at doing amendments to the Superannuation Guarantee Administration Act to enable certain employees with multiple employers to apply for an employer shortfall exemption certificate, which prevents their employer from having a superannuation guarantee shortfall if they do not make contributions for a period. It's also looking at making some consequential amendments to the Administrative Decisions Judicial Review Act 1977 and the Income Tax Assessment Act to ensure that a superannuation entity's non-arm's length income includes income where expenditure in gaining or producing it was not an arm's length expense. And it's also going to look at amending the Income Tax Act and the Tax Administration Act to ensure that in certain circumstances involving limited recourse borrowing arrangements, the total value of the superannuation fund's asset is taken into account and working out the individual member's total super balance. Okay, so the following superannuation bills are waiting progress in the Senate. So the Treasury Law Amendments Improving Accountability and Member Outcomes in Super Member Number 2, Bill 17 is before Senate. It amends the Superannuation Guarantee Administration Act to provide that employees under workplace determinations or enterprise agreements made on or after the 1st of July 2018 have the right to choose their superannuation funds and provide that amount sacrificed under an employee salary sacrifice arrangement will not reduce an employer's mandated super guarantee contributions. The Superannuation Excess Non-Concessional Contributions Tax Amendment, National Disability Insurance Scheme Funding Bill 2017 is part of a package of 11 bills to fund the Commonwealth's contribution to the National Disability Insurance Scheme. So this bill amends the Superannuation Excess Non-Concessional Contributions Act 2007 to increase the rate at which excess non-concessional contributions tax is payable on an individual's excess non-concessional contribution. It's going to increase this from 47 to 47.5%. And the last bill that is super-related waiting progress in the Senate is the Superannuation Excess Untaxed Rollover Amounts Tax Amendment National Disability Insurance Scheme Funding Bill 2017. It's also part of that same package I discussed before, and it's going to amend the Act to increase the rate at which excess untaxed rollover amounts tax is payable on an individual's excess untaxed rollover amount, and that too is increasing from 47% to 47.5%. Okay, the next part of our webinar is we're going to look at the ATO website updates. So the ATO website updates in recent months that relate to superannuation funds include some of the following. So, is establishing an SMSF right for you? So following ASIC's review into the quality of advice in setting up and running an SMSF, the ATO has released a web page summarising the obligations and responsibilities that come with running an SMSF. The SMSF March 2018 quarterly statistics on SMSFs, I should say, has been released by the ATO. The downsizer contribution into Superform is available on the ATO website. They also have released some information for funds that want to create their own form on how it should be set out, things it needs to include. There's also a link that shows you the SMSF annual return changes. So as a result of the super changes that came into effect on 1 July 2017, there are a number of changes to the 2018 self-managed super fund annual return. And another key update that's been on the ATO website is the compassionate early release of super. So from 1 July 2018, as they've outlined in CRT Alert 053/2018, the ATO is going to has taken over responsibility for administering early release of superannuation on compassionate grounds from the Department of Human Services. So fund members will now need to apply directly via MyGov. The funds will receive a simultaneous electronic copy of an approval notice from the ATO when they have approved a compassionate release application. They will also receive these ATO compassionate releases via the BDE service. Okay, so there are some of the key updates. So now let's look at our contribution caps for the 2018-2019 financial year. So the general concessional contribution cap remains unchanged at $25,000 for all individuals regardless of age. However, most taxpayers under age 75 have the opportunity to claim a tax deduction for personal super contributions made to a complying fund or an RSA. The non-concessional contributions cap also remains at $100,000 for members. The non-concessional contributions cap will be nil for a financial year if your total super balance is greater than or equal to the general transfer balance cap, which is currently $1.6 million at the end of the 30 June for the previous financial year. So now let's have a look at some of the other key super rates and thresholds that apply for the 2018-2019 year. So the ATO has published the key superannuation rates that include the superannuation guarantee. The maximum super contributions base for the 19 financial year is $54,030 per quarter. The CGT cap amount for non-concessional contributions is now $1.48 million, and the Division 293 tax threshold amount for 2018-19 remains unchanged at $250,000. Employment termination payments. So the ETP cap amount for life benefit termination payments and death benefit termination payments for the 19 year is $205,000. The tax-free part of a genuine redundancy payment and early retirement scheme payments for genuine redundancy and early retirement scheme payments for the 19 year, the base limit is going to be $10,399, and for each completed year of service, it's another $5,200. The superannuation benefits cap, the low cap rate for 2019 is $205,000, and the untaxed plan cap amount is $1.48 million, and the co-contribution maximum entitlement for the 19 year remains at $500. However, the lower income threshold has increased to $37,697, and the higher income threshold has increased to $52,697. The ATO's safe harbour interest rates for related party limited recourse borrowing arrangements remains unchanged at 5.8% for a related party LRBA to acquire real property and is 7.8% for listed securities. All right, there's been a lot of talk about this in the media. It's a 3-year audit cycle. So Treasury released a discussion paper on the 6th of July 2018 regarding its proposal to change the annual audit requirement to a 3-year audit cycle for SMSFs with a history of good record keeping and compliance. So the closing date for feedback and comments is the 31st of August 2018. Treasury has advised that the objective of this measure is to incentivise good record keeping and compliance by SMSFs whilst maintaining system oversight and integrity. So with this proposed 3-year audit cycle, the eligibility for the measure will be limited in 2 ways. So good record keeping and compliance. So SMSFs will need to meet eligibility criteria of timely submission of their tax returns and 3 consecutive years of clear audit reports to move from an annual audit cycle to a 3-year audit cycle, and key events. So an SMSF on a 3-yearly audit cycle will be audited in every year in which a key event occurs, with such audits covering all years since the previous audit. So some examples of what these possible key events include are the commencement of a superannuation income stream by a member for the first time, the death of a member, the addition or removal of a member, the receipt of non-arm's length income, the commencement or maintenance of a limited recourse borrowing arrangement, the acquisition of an asset from a related party, investments, loans or leases with a related party, or any in-species lump sum payments to a member. First home super saver scheme. Okay, so from 1 July 2018, individuals will be able to apply to withdraw voluntary contributions made to their super after 1 July 2017 for a first home. So voluntary contributions include undeducted, which are our non-concessional personal contributions, deducted, which are concessional personal contributions, and any salary sacrifice contributions. Now, up to $15,000 of voluntary contributions made in a financial year count towards the amount that can be released. The maximum amount that can be released is $30,000 of personal contributions plus associated earnings. So concessional contributions and earnings that are withdrawn will be taxed at your marginal tax rates less a 30% tax offset. Okay, so transition to retirement income streams. I'm going to talk a little bit about these and the tax consequences that have come about since 1 July 2017. So transition to retirement income streams are currently available to assist individuals to gradually move to retirement by accessing a limited amount of super. Previously, where a member received a tryst, the fund received tax-free earnings on the super assets that supported it. Effective from 1 July 2017, the government removed the tax-exempt status of earnings from assets that support a tryst that is not in retirement phase. So the earnings from assets supporting a non-retirement phase tryst will now be taxed at 15%, regardless of the date that the tryst commenced. So this means that a fund is now paying a fund paying a non-retirement tryst is taxed as if the members were in accumulation phase. Members will also no longer be able to treat super income stream payments as lump sums for taxation purposes. So the intent of these changes was to ensure that trusts are not accessed primarily for tax purposes, but to actually support individuals who remain in the workforce. So under these changes, we now have 2 phases to a transition to retirement income stream. We have a non-retirement phase and a retirement phase income stream. It's important to note that the tax treatment of a trust in the hands of a member personally has not changed with these changes, and it continues to be taxed in exactly the same way as a full retirement account-based pension. So this means that members aged 56 to 59, the tax-free component of the benefit is still exempt from tax, whilst the taxable component will be subject to tax at marginal rates with a 15% tax offset. And members aged at least 60, the tax-free component is exempt from tax, with the taxable component also generally being exempt from tax. So what is a non-retirement phase trust? So it's still an income stream, so the minimum and maximum pension limits remain. These are all based on your age. Earnings are taxed at a maximum of 15%, and it does not create the need to have a transfer balance account credit at 1 July 2017 or upon commencement, nor any other T-bar events. So a trust converts to the tax-free retirement phase automatically when a member turns 65. It also does this when the trustee is notified that the member has satisfied a condition of release with a nil cashing event. We'll go over what a nil cashing event is in the next slide. So when you have a tax-free retirement phase, a transfer trust, a transfer balance account credit is going to occur, and you're going to need to lodge a T-bar report with the ATO. Now, it's eligible to count towards claiming the exempt pension income, and tax-free earnings. The 10% maximum pension limit will no longer apply, and the commutation restrictions around that TRIS will no longer apply either. So what are our conditions of release with a nil cashing restriction? So the ones that relate primarily to a TRIS is, as we've already said, attaining age 65. Now you have retirement on or after preservation age. Another condition of release is death, but that's probably not going to help you. Permanent incapacity, termination of gainful employment, restricted non-preserved amounts, and terminal medical condition. So let's get the next one. Oh, we've gone too far. Okay, so retirement. I'll go back another one, sorry, I've got trigger happy. So back looking at this the conditions of release, and when we're talking about retirement on or after preservation age, the definition of retirement will depend on the member's age, and it's generally summarised as follows. So in the case of a person who has reached preservation age and is less than 60, so it's an arrangement under which the member was gainfully employed has come to an end, and the trustee of your superannuation fund is reasonably satisfied that the person intends never to again become gainfully employed for 10 hours or more each week. A person with a preservation age of less than age 60 who ceases gainful employment before age 60 may still retire after age 60, provided that the trustee is satisfied that at the time of the benefit claim, the person intends never to again become gainfully employed for more than 10 hours each week. In the case of a person who has attained the age of 60, the retirement condition of release is satisfied where an arrangement under which the member was gainfully employed has come to an end, and either of the following circumstances apply. So the person attained that age on or before ending of the employment, or the trustee is reasonably satisfied that the person intends never to again become gainfully employed for 10 hours or more each week. Therefore, if a member is age 60 or more and is employed by two separate employers, the termination of one arrangement is sufficient for the member to satisfy the retirement condition of release. That is, the member can retire for the purposes of commencing an account-based pension by ceasing one employment arrangement, even though they may still remain employed under another arrangement. Okay, so really what it highlights is that it's really important to communicate with your accountant, super administrator, financial advisor before you commence such an income stream. But it also means that when you have satisfied one of the conditions of release that I just discussed, that you make sure that you communicate that to them and notify the trustee of the super fund so that you now get this tax exemption, and all the other restrictions and things that we've talked about, the 10% restriction, will no longer apply. Okay. And I think I mentioned that before, that when you have your retirement phase TRIS, transfer balance account credit you'll need to lodge a T-bar, and 10% maximum no longer applies. Yep, I definitely said all that before. Okay, so guys, that concludes today's quarterly superannuation tax update. So Vincents Superannuation Advisory is here to work with you to ensure that your self-managed super fund structure is fit for purpose to achieve your desired outcomes. There are lots of different ways that we can help you with this. So it's not just lodging your tax returns and preparing the financial statement each year. We can help you with structuring and strategy advice. So when we talk about this, talking about making sure that we help ensure your investments are held in the most tax effective way, whether that's held in super or outside of super, and that we also, where you are holding them in super, are making sure that they comply with the relevant super legislation and regulations, because there are quite strict investment rules that apply to super funds that don't apply to other entities such as, your general companies. We can help you with your retirement and estate planning. So this includes facilitating the preparation of death benefit nominations and working with you to help update your trust deeds. We will work with you and your lawyer to ensure that your superannuation estate matters are tailored and set up to achieve the goals that you want, and so that try and make sure that everything will go to your nominated beneficiaries in the way that you want. We also offer a full range of consultation services to just not only our SMSF trustees, but also to accountants and lawyers. whether it be assistance with helping with superannuation and divorce settlements, some highly technical compliance matters where someone doing some compliance needs a little bit more help, or just assisting if you need a court-appointed expert witness, or sorry, not a court-appointed, but if you need an expert witness, we have been court-appointed. We can help you. We're a one-stop shop. So, as I said, that concludes the slide, our presentation. If you have any questions in regards to anything that has been raised in this webinar or anything at all, feel free to contact me directly on my email. Details are there, or give me a call on that number. All right, thank you very much.